the voice later, right? Like in the, like running your mouth like in the mute movies, and then the sound comes after. Welcome to Discovering the Law. My name is Lucy Rivera. This episode can be viewed at www.discoveringthelaw.com. And today we have an honored guest, a very special guest, Professor Sara Kelsey. Professor Kelsey is a solo law practitioner, and he also teaches banking at New York State University School of Law. New York School of Law. It's not a state university. And she also teaches banking fundamentals at Boston University Law School, and also at the University of California at Berkeley. Professor Kelsey, thank you so much for being here today.
Thank you.
And Professor Kelsey is here to discuss the financial crisis. And Professor, please tell us what is what we know as the FDIC?
Why is Lucy asking me what is the FDIC? It's because I was the general counsel of the FDIC, and in fact, during the financial crisis.
Yes.
And not many people really know what it does. You see the FDIC in the corner of the window of your bank, and it makes you feel somewhat secure, but you really have no idea what it does. It's an amazing organization. And I got to know it pretty well during the crisis. It not only insures your deposits up to $250,000 per bank, which is very comforting in times of trouble, but in addition, if a bank fails, it's the entity that acts as a receiver and handles the failure of the bank. So it has two roles.
And so that, having that role in mind, what did this agency do during the financial crisis? What was its role?
The FDIC did what it usually does, which is it took care of banks that were failing. There were quite a few. Normally, there will be only about 5 or 6 banks that fail in a given year. If you don't have a bank crisis. But during the banking crisis, quite a few more banks failed. That peaked in 2010 with about 157 banks failing. And you've probably seen on those Friday afternoons, you see the news flash that such and such a bank has acquired a failed bank. And these happen usually on a Friday. And that is the basic thing that the FDIC does. But in this crisis, it was a different crisis in a way because people weren't concerned only with insured depository institutions failing. They were worried about institutions in the entire financial system failing. And the FDIC did not have that much of a role in those institutions.
But Professor, in these institutions, for instance, and we can name them, that Lehman Brothers, Bear Stearns, these are other entities. Why they were also the cause of the failing of the financial crisis? Tell us about that and the role of why didn't the FDIC?
excellent question. It's confusing because during the financial crisis, you would pick up a newspaper and you'd hear about a bank failure. And you'd read Bear Stearns, the bank failed, or AIG, the bank failed, or,
Yes.
you'd hear all these other entities that were bank failures. Bear Stearns, Lehman, they were not banks. They were broker-dealers. They were companies that were holding companies for other financial entities. They were not insured depository institutions. The FDIC was created in 1933 in the midst of the Great Depression to address the fact that people who kept their deposits in banks needed those deposits to be kept safe. And also the financial system is run through those banks, and so it was to make sure that if a bank failed, it was taken care of very quickly. So in the past, that's really the only kind of bank failure that people were concerned about, and that is the kind of bank failure that the FDIC does. This last financial crisis had a lot more financial entities, non-bank entities, failing.
Yes, such as banks, which are accept deposits, but also these other entities that are not banks. Why would they be? Like they are investment advisors.
Right. It's really interesting. If you're a member, just a regular person, and you try to think of what is a bank, you will be very, very confused. And one of the reasons you'll be confused is because insured depository institutions are owned by holding companies. Those holding companies own a lot of other companies, insurance companies, broker-dealers. So take JP Morgan Chase. That's a holding company. It has an insured bank within it, but it has broker-dealers, it has insurance companies, it has investment advisors. And it was at the level of the large holding company that a lot of the distress was happening, yet the FDIC's powers from 1933 were directed only at helping that insured depository institution.
That is such an important difference to know, and for people to know that the banks had insurance, whereas the big holding companies didn't. But they also caused the financial crisis.
They did. And in the past, what would happen if an insured depository institution that had a holding company parent, and that holding company parent might have had other subsidiaries, the FDIC would just take care of that insured bank. The rest of the financial system would be dealt with under bankruptcy law. And the FDIC would be using its rules to deal with the failure of the bank, and the bankruptcy courts would be using their rules to deal with the failures of the surrounding entities. So you would have strange situations where you would have a failed bank, but the company that owned it was perfectly healthy. So the bank was in resolution by the FDIC, but the holding company was going along its way. It had plenty of healthy subsidiaries. Sometimes you had the opposite, and you had a perfectly healthy bank, and the companies around it, including the one that owned it, were in bankruptcy. So you had these two different processes happening at the same time. And sometimes a bankruptcy trustee and the FDIC would be fighting over where should the money be. Should the money be in the bank available to the depositors, or was it money that belonged to the holding company that should go to the shareholders of the holding company?
And that is great. Professor, would you tell us more about that? That is an incredibly interesting distinction as to why banks don't file for bankruptcy. And I'm sure the people in our audience are not aware of this.
Yes.
Fact.
Well, it's in 1933, Congress decided that you can't really rely on bankruptcy in the instance of a failing bank. Why not? Well, it's because what bankruptcy is about is very different from what bank resolution is about. In bankruptcy, it was a reaction from what had happened in England in the past, where debtors were treated very poorly. And in America, they had one of the central laws that they started out with was bankruptcy law. Mm-hmm. And the goal of bankruptcy law was to give that company a second chance. Mm-hmm. It was also to make sure that the creditors were treated fairly. Mm-hmm. So bankruptcy can go on for a very long time. Before 1933, when banks were resolved under bankruptcy law, sometimes it took as long as 21 years for a bank to be resolved. And the depositors got just a fraction of their deposits back at the end of the 21 years.
However, yes.
So Congress created this really fast-track thing for bank resolution. So the FDIC does not have to wait until a bank files for bankruptcy. The FDIC goes ahead and all by itself starts resolving the bank. After the bank's chartering authority says this bank is failing, they then call in the FDIC, and the FDIC quickly deals with the situation. And what do they care about? Are they concerned about the shareholders? No. The creditors? No. What they're trying to do is make sure that the financial system survives, make sure that the depositors are protected. So they have a different goal. And then what are they trying to do? Are they trying to take 21 years to be fair to everybody? No. They are trying to do something absolutely quickly and seamlessly. And so they're given superpowers. They can do all sorts of things, such as abrogating contracts, to resolve the situation very quickly. So they're very, very different processes.
And that is fascinating, I find, that it's as if a carte blanche to save the bank. And I think there is just so much about this.
Actually, they're not trying to save the bank. They're trying to save the economy.
Very good.
And they're trying to save the deposits of the depositors. They're not trying to save the bank. The minute the FDIC is appointed a receiver, the bank is dead.
Oh, interesting.
So it's only its assets and liabilities that are assumed by another bank.
And how did it happen? While we do have some time to discuss that this failing institutions were to be acquired by somebody else. Like, how did that happen? Like process of shares, or like how did that?
Yeah, well, it's interesting to talk about that in the context of the crisis, because normally what the FDIC does, they have a whole rapid process. When they realize the bank is failing, they try to figure out what their assets and liabilities are. They very secretly market it to prospective purchasers. There's a bidding process. The FDIC is charged with trying to get the best value for the FDIC fund to protect the taxpayers. So the whole thing is very quick. And during the financial crisis, the problem was that a lot of the entities that were failing were not insured depository institutions. They were broker-dealers, they were holding companies, and the problem was there was nothing like bank resolution that existed for them that was quick, that was seamless, that could make sure that the economy could continue. That did not exist. And people not having that tool felt the Federal Reserve and the Treasury did not have those tools, but they felt responsible for the economy to make sure the economy continued. But they didn't have the FDIC's tools, and the FDIC had those tools, but only for insured depository institutions. So what happened is the Treasury and the Federal Reserve Bank of New York and the Federal Reserve Board used whatever authorities they had and on an ad hoc basis tried their best to save the situation.
Professor, after this crisis, Congress must have had, as you say, there weren't enough tools. What was Congress' response to this crisis of 2008?
Yeah, Congress had a few responses. One of the responses is they decided that they never, ever wanted to see any more bailouts. Mm-hmm. They also decided that they did not want to see too big to fail continue. And what do we mean by too big to fail? That is, they didn't want to see the situation where large financial institutions were propped up because everybody was afraid of what would happen to the financial system if they failed. So what did Congress do? It did a couple of things. One thing that it did is it cut back on the powers that the Federal Reserve and the FDIC had to deal with the crisis, because they felt that some of those tools, although they were used to try to deal with the absence of the appropriate tools, they just didn't want to see those tools used ever again. So one thing they did is cut back on some of the authorities. Another thing they did is they created a resolution authority that could be exercised. They chose the FDIC to be the institution that exercised it, and it will apply to those large holding companies and also non-bank financial institutions that pose a threat to the financial system.
Professor, what is the difference between this fighting for bankruptcy for big, large holding companies versus that resolution? What is the difference?
Yeah, well, as I was saying before, the goals of bankruptcy are very, very different from the goals of bank resolution. Mm-hmm. And one of the things that Congress likes about bankruptcy, and so do large companies, is it's kinder to creditors, it's fairer to creditors. But on the other hand, when you're in a financial crisis, people don't feel like you have that kind of time to play it out with the time it takes to do that. So there was a kind of a compromise that Congress came up with. Mm-hmm. They came up with a situation where they said, okay, large companies and non-bank companies should be relying on bankruptcy law, but it looks like nobody was prepared to apply bankruptcy law to them. Mm-hmm. So they came up with this thing that's now called the living will, where all these companies have to report to the Fed and the FDIC how they would be resolved under bankruptcy.
Interesting.
That's the living will. Yeah. But in the meantime, it also said to the FDIC, you make sure that you understand these large, complex banks and try to understand also their holding companies in case it happens that they will need to be resolved under resolution authority that's much more FDIC bank-like.
And what is a large financial institution? How would you describe it? What are the assets and how much?
Yeah, $50 billion is basically the cutoff that Congress came up with, $50 billion in assets. So it's not your community bank, it's not even your regional bank, but the very large, it's basically the banks that we all thought of as too big to fail. So Congress said, if everybody thought they were too big to fail, while they're healthy, let's figure out how they would fail under bankruptcy, and let's make sure the FDIC is ready in case we can't use bankruptcy and we have to go through resolution.
Yes. Professor, now these measures, that you have been discussing, if there are any others that you would like to talk about, please let us know. And because what my question was, in addition to those measures that were implemented then, do you think those measures would be implemented if, as a response of something that could happen, another crisis that we could face? And if you would like to take.
Yeah, no, I think that I'm pretty hopeful. I think of first of all, Dodd-Frank was created to try to make a lot of improvements in our banking system. But I actually think putting in the resolution authority and making the FDIC in charge of it and making everybody responsible for planning for it was wonderful. Because the main problem during the financial crisis really was that nobody had the tools to deal with it. So having the tools ahead of time to deal with it, that everybody knows what they are, means that it will be less of a panicking situation, because regulators won't be trying to use whatever authority they can to do whatever thing they think at the moment might be the best thing. They'll have a planned thing that they can do. They'll have the clear authority to do it. People will know what it is, so it will be much calmer.
And Professor, just because it seems like we talked about so many institutions, maybe would you describe that family umbrella where the parent and the bank, maybe describe to us, what is a bank, for instance?
Okay, the hardest question of all. So a bank basically is an institution that takes deposits. That's really what it does. But because they take deposits, they actually are a center of our economy, because that bank is used by the Federal Reserve to implement its monetary policy. That bank is used as the means that our payment system works. So that bank is very special and is very important. However, the way we have evolved in the United States, which is pretty unique. Most countries are not like this. Most countries have a bank, and then that bank has subsidiaries. But in the United States, banks have companies that own or control it, and they're called holding companies. And those holding companies can have a number of other businesses hanging off of it. It's very confusing, because most people think of that entire thing as one entity, and they call it a bank. But indeed, it's not.
As you said.
So there's, and the legal authorities depend on those legal distinctions. So I think that going forward, the legal authorities are going to be a little more aligned, better aligned with how we're actually organized. We can no longer say that the only thing we have to worry about resolving in a crisis is that insured depository institution, because we learned in the last crisis that's not enough. There are other very large players in our financial system where we have to have a plan. We have to know what to do, and we have to have the tools to do it.
And Professor, would these same tools work today?
The tools that are in the Dodd-Frank Act, I think will work, but you're never going to know until the next crisis. You're never going to know. But I can tell you that all of the agencies and all of the banks are trying to prepare.
Well, Professor, we've run out of time. But for our viewers, this has been an extremely interesting and very eye-opening description of the financial crisis and banks with Professor Sara Kelsey, who has a solo law practice, but also professor in the New York University and at the wonderful Morin Center of Boston University Law School, and at Berkeley, California Berkeley School of Law. Thank you, Professor Kelsey. So good to have you.
Thank you.
And thank you all. My name is Lucy Rivera. This episode can be viewed at www.discoveringthelaw.com. Thank you for watching.